And that's the closing bell on Wall Street. And now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre joins us now with the latest. Jared, how did stocks close out the session?
At the lows, unfortunately, so not the best start to the month of December. Here is the Dow, and you can see there those lows reached right less than a minute ago. You can see it's down 427 points, or about 0.9%. Good news is not even 1%, so kind of a blip in the long-term scheme of things. Here's the NASDAQ off of the lows. Actually, the lows were reached in the first minutes of the day, so pretty well off of those, only down about 0.4%. And here's the S&P 500. Lows were also in the very early part of the day, although it did end on kind of a sour note right there. Also, take a look at the Russell 2000, that's a small cap index, and we saw another late day slide that we were talking about an hour ago, and it didn't really do much since then. And just taking a survey of the sector action here, we see energy still held on to the #1 slot. That's up 1%, followed by tech and consumer discretionary, just barely holding on to some gains here. And as I was pointing out at the 3 p.m. hour at the beginning, utilities taking the biggest dive here, 2.3% to the downside, and that is off of the back of higher interest rates. Those long-term rates were surging, partly in response to the yen situation, and the BOJ may be hiking later on in the month. Anyway, kind of an interesting day in terms of those dynamics. And nevertheless, we're also seeing healthcare down almost 1.5%, industrials, real estate, each of those down more than 1% as well. Here is the NASDAQ 100. We got some green, we got some red. NVIDIA and Apple, two of the biggest stocks, closing up over 1.5%, but then Alphabet and Microsoft finishing down more than 1%, along with Meta. Broadcom probably sticking out here the most. It's down 4% today. And let's take a check of the Dow as well. Aside from some of the bigger names, we're seeing a lot more red than green. Walmart, that consumer staple, a defensive name, that was up today. Disney up 2, Salesforce up 1. For the most part, seeing just a lot of medium-sized red, we'll call it that. And transports, I believe they eked out a small gain today. You wouldn't know by seeing all the red here, but we do have some outsized performers here from Old Dominion, J.B. Hunt, each of those up more than 3%. And I will leave us on our leaders one more time. China, looking like it was green today, along with regional banks, but Bitcoin and aerospace and defense and biotech really didn't have the greatest days today. Allie.
Yeah, definitely not the best day for Wall Street, Jared. Thank you so much. Well, a tough day to start the month of December. Stocks closing near the lows of the day. And my next guest is staying neutral on equities for now because the market is vulnerable to disappointment. Joining me now is Adam Phillips, EP Wealth Advisors Managing Director of Investments. And Adam, let's start there. You're neutral on equities, market's vulnerable to disappointment. What are those disappointments in your view? And what would turn you a bit more constructive on stocks moving forward?
Yeah, absolutely. Great to be with you. We are, I'd say, self or risk aware right now. And really what that means is that we see opportunity from here, but we are also mindful of a lot of risks. Some of those risks have recently been taken off the table. One of those was the anticipated Fed cut at next week's meeting. There's now 100% chance of that happening, it looks like, but there's still some risk. There's still a lot of questions and scrutiny and some doubt around AI investment, whether that will ultimately pay off and when that will pay off for those hyperscalers that have been throwing so much money at this for so long. You know, another concern is really coming up in this lack of data, this dark period that we're going through right now, where a lot of the data really isn't coming along as scheduled as a result of that recent government shutdown. So to an extent, we're still flying blind when it comes to things like inflation, like the labor market. And so we kind of assume for now that the trends that were in place prior to the shutdown are still moving in that direction. Labor market is weakening. What impact will that have ultimately on the psyche of the consumer, their propensity to spend going forward and support the economy? And what does the inflation outlook look like for risk assets, for fixed income, and ultimately for consumers?
And you are overweight large cap tech, underweight small caps. You were just talking about Fed rate cuts. Does that thesis change if we see continued easing? And I guess how necessary is the rate cut story when it comes to the broadening of this market?
Look, that's a great question. I think that's one that we're asking ourselves here internally. That next week's rate cut appears to be a done deal. That's pretty much baked in, and it would appear, based on the market's response following that recent 5% pullback, that it's now fully priced into the market. So the question is, where do we go from here? What is the Fed signal coming out of next week's meeting? How many more rate cuts could we get? I think that's still an open question. We're looking at maybe ballpark 2 following this December rate cut. Will that really move the needle that much? The question is, how much can they do if inflation is still at 3%? And we know that next year we're going to get additional fiscal support. We're seeing a net increase of about $150 billion in the form of fiscal support on consumers and households coming from the One Big Beautiful Bill Act. So I think that's really a big question mark. Ultimately, it is certainly a variable that comes into play. Now, without it, I will just say that one of the reasons we expect this market to broaden out, we still have an overweight within large cap, and we expect that's where we'll remain. But we do expect the market to broaden out among those large cap sectors because earnings growth is expected to broaden out next year. It'll be the first time in quite some time that we're looking at earnings growth on a year-over-year basis across all 11 sectors of the S&P 500. So I think that's really important. But we're still reluctant to go down cap. We still have an underweight in small cap and mid cap, just because rates would have to come down quite a bit more to really provide that boost, that catalyst that is needed for those smaller companies.
And you mentioned earnings growth, and that is one of the reasons why we are seeing really intense optimism heading into 2026, with a lot of strategists raising their S&P 500 price targets. Deutsche Bank has a rating as high as 8,000 for the S&P. Do you think that's realistic, or are these analysts kind of getting a little too over their skis here?
Yeah, look, I think that right now, so far it's realistic. But we need to watch this very, very closely. We're coming out of the third quarter earnings season. That went very, very well. It's really same story we've seen in recent quarters, where these expectations are set relatively low and these companies blow it out of the water. It's just excellent earnings. And so because of that, we're seeing earnings expectations continue to move higher over the next 12 months. That being said, there is the risk that earnings do disappoint. And I would just highlight the fact that in this concentrated market, we're looking at the 10 largest companies that collectively account for about a third of S&P 500 earnings. And so if we see weakness among those names, that could really derail plans for this double-digit earnings growth next year. So for now, I think it is certainly doable. And what we are expecting is that, we've seen so far amid this trade uncertainty, all of this tariff related uncertainty, that companies so far have shown an ability to navigate that. And we expect that those headwinds will subside in the coming months, and that'll be supportive of earnings going forward. But ultimately, we need to wait and see. So
it seems like what you're saying is it's very possible we could see pockets of really intense volatility, which we've experienced over the past month. So how do you invest around that, especially heading into next year, where a lot of those same market themes, sticky inflation, a cooling labor market, they're still going to be at play?
I absolutely, and I think that it is so critical to just set your expectations accordingly. Next year should be very similar to this year in terms of that uncertainty, and that's just, it comes with the territory. It's the price of admission when you're investing in stocks. I viewed the most recent volatility, even though it was just a 5% drawdown, I hate to say that I celebrate it. We certainly don't like to see downside volatility, but it is healthy. And so what we're telling our clients is just to set your expectations accordingly. We know that this year's performance really surprised a lot of people, especially coming off of 20% plus returns in the prior 2 years. Now we're looking at excluding dividends, about 16%, 15% on the S&P 500 so far year to date. And so set your expectations. It's going to be a little bit more difficult. It could be choppy here as the expectations start to grow for this payoff from all of this infrastructure investment around AI. Will this ultimately produce the productivity gains many are counting on? This market, as you said to open, is really just, it's vulnerable to those the misses on expectations. And so we need to be mindful of that, but ultimately play the long game.
All right, Adam, real quickly there, if you're playing the long game, what sectors or specific stocks would you be bullish on within this current market setup?
Absolutely. Well, the sector that we really like right now is financials. When we're talking about the outlook going forward, I would just highlight one thing we haven't talked about is that next year is a midterm election year. Historically, these are a little bit more volatile and challenging for stocks. But we do believe that President Trump is aware of how difficult this midterm election year could be and how many seats could potentially be lost. And so he and the administration will look to provide support to the economy in any way that they can. What that means is that year one was largely about immigration, about trade. Next year could be about deregulation, one of the themes that many expected immediately following the 2024 election. That bodes well for the financial industry. This is a sector that accounts for about 20% of S&P 5 earnings, but only accounts for about 13% of the overall weight within the S&P 500. So it punches well above its weight, and it is relatively attractively valued. I would just highlight one more thing. As we expect rates to come down, we're also looking at long-term rates, which could actually move higher. This is the first time in over 40 years that the Fed has been cutting rates, and we haven't seen long-term bond yields move lower. We've seen them move higher. That spread actually bodes well for financials, which borrow on the short term and long and lend at the long term.
All right, Adam, appreciate it. Thanks so much.
Thank you.
Well, coming up, the biggest market moves today, we're in the crypto space. We're taking a closer look at the sector and the risks to the broader fintech space as a result. Crypto under sharp pressure today. Bitcoin trading around the $85,000 level, and the weakness rippling across stocks tied to the industry. MicroStrategy, Coinbase, Robinhood, all closing sharply lower. Joining me now is Owen Lau, Clear Street Managing Director and Senior Analyst. And we were just talking in the break how significant this slide in Bitcoin is. We're now down 9% since the start of the year. What do you attribute this slide to?
Yeah, there are a couple of reasons. So let's go back to October 10th. So there was a massive liquidation in the crypto space. The amount was about $19 billion. And then since then, the liquidity has dropped quite dramatically. If you talk about today's move, I would attribute that to three key reasons. Number one, it's Bank of Japan signaled that there may be interest rate hike this month. The second one is there was a hack on a DeFi platform earlier today. The third one is there was a conversation about the Operation Choke Point 2.0 that could be coming back. So that all aggregate into maybe it kind of magnified the auto deleveraging problem. We saw that back in October 10th.
And it just speaks to how interconnected crypto is, all the different currencies. You have these companies that also are very exposed to crypto struggling today. And I know you're bullish on names like Coinbase and some of those other players, but when you have so much volatility in the actual cryptocurrencies, how does that feed into sentiment versus fundamentals? Yeah,
so first of all, I want to mention that there is still a high correlation between the cryptocurrency and also crypto equity. So that's why I advise investors to look at these on a longer term basis. Like that high correlation just shows that the immaturity of this asset class. But over time, I think that correlation could break. So to me, I would say investors should look at this on a longer term, maybe 3 or 5 or 10 year basis for the investment.
Because fundamentals could essentially go out the window if you have Bitcoin that has a drawdown of 20%.
Correct. To me, that's actually a buying opportunity because I went to many conferences last month, for example, Money 2020, WIPO, and also Chainlink conferences. What I've been hearing is blockchain adoption continues. More and more TradFi companies are getting into this space and launch crypto products. So to me, the fundamentals are actually very strong. But we have to, but we have to play a longer-term game.
You have to be comfortable with the volatility that comes with riding the Bitcoin crypto wave at large. And what about the outflows in Bitcoin ETFs? Should that be a concern for investors? Because we've been hearing more and more that there's increased outflows there.
So that was part of the large liquidation we just talked about on October 10th. And when you see that large liquidation, some investors, if you don't have a longer term view and you start to lose money, they may try to stop loss, right? So one reaction they would take is to just sell the Bitcoin or other tokens. So that could cause a lot of the outflow. But again, if you look at these kind of names on a longer term basis, I would say longer term, the fundamental is still pretty strong.
So longer term fundamentals are so strong. What other catalysts are you looking at that will drive crypto hopefully higher in the future?
So one key catalyst we are looking at is regulatory clarity. So thank God we have, we used to have the government shutdown and now government reopen. I think this is a prerequisite for the government, for the Congress to think about or come back to think about the market structure bill. In the House, they call it the Clarity Act. And in the Senate, they're developing their own market structure bill. My expectation is it could come back to the market earlier next year. That could be one key catalyst for the whole industry.
So you've been talking a lot about more crypto adoption, all the catalysts on the horizon. How should an everyday investor be positioned within the crypto market? Is it through direct exposure through some of these ETFs or maybe some of these crypto adjacent names?
Yeah. So I would say, first of all, think about from a capital allocation perspective. Don't just allocate 100% of your capital into crypto space. To me, the better or a good starting point is maybe you allocate 1% or 2% of your overall wealth to the crypto space and try some of these tokens or crypto equities first. And then once you feel more comfortable, you can start increasing that allocation to maybe about 5%.
And it obviously always depends on your risk tolerance and where you're at in your investing journey. One of the big themes in your research is blockchain for cross-border payments. How real is that shift and who could benefit most from something like this?
So based on our estimate, the TAM, it's about $40 trillion. When we talk about the cross-border B2B payment opportunity. So it is a big opportunity. But right now, there are many large companies are kind of occupying this space. But because blockchain can make the transaction faster, cheaper, global, and instant. So that's why it has an opportunity to disrupt this space. And again, this is a $40 trillion opportunity. This is huge.
All right, this is huge. We will have you back to see where things are. Hopefully, we've climbed back from some of these losses. But Owen, thank you so much for joining us today. I appreciate it.
Thanks a lot.
Well, Congress is back in session with a lot to do and only a few weeks to get it all done. Yahoo Finance's Washington correspondent Ben Werschel joins us now with the latest. So Ben, Congress is back, stack of new deadlines, and the biggest one is this looming January 1st expiration of those enhanced Obamacare subsidies. This was a big sticking point in those government shutdown negotiations. So walk us through what's at stake for Americans and what a realistic path forward could look like.
Sure. Yeah. So we've got 3 more weeks of Congress, and this healthcare vote will happen one way or another. It was part of the shutdown deal, was a promise for a vote. What the issue at the moment is that there's no clarity on what's going to actually be voted on. This could be a partisan exercise that will sort of fall short of 60 votes and do nothing for the 20 million Americans who rely on these enhanced Obamacare benefits, or there could be some substantive deal, which both sides are pushing for, but is a real heavy lift at the moment, with some pretty heavy disagreements. So that is to be hashed out this week. Talks are ongoing, I'm told, and there's also going to be a Senate hearing on Wednesday on this issue, where this issue of healthcare prices are going to be discussed. So this is the week that is going to be hashed out. Also being hashed out this week are a couple of provisions on AI that are also of interest to the business community. What some lawmakers are trying to do is get some of those provisions into the end of the year defense authorization bill. One around banning states from regulating AI. One around AI chip exports. That's also being that has some big proponents but big opponents on Capitol Hill. So that's being trying to get included as well. These are the two kind of big economic issues that Congress has to deal with, in addition to a whole lot of other stuff that it's got to get done before December 18th, when everyone heads home for the Christmas holiday.
Yeah, but definitely a busy push into that Christmas holiday. But we also got this new US-UK deal on zero tariffs for pharma and medical tech, and Britain is now agreeing to pay more for medicine. So how significant is this, and what does it really mean for drug makers and pricing policy moving forward?
Yeah, so this is a significant change. The Trump administration is touting this as an agreement in principle, so there's clearly still some details to be worked out. But as you mentioned, the main give from the Trump administration is less tariffs. The main give from the UK side is increasing the price they pay for certain new drugs, not necessarily drugs that are already on the market. So it is a change here. It's a big win for pharma. I think clearly Bristol Myers Squibb has already released a statement talking about how they're going to increase their investment, or they can increase their investment as a result of this deal. It kind of helps them on both sides of this deal. It's also a win for the Trump administration's case that they can use tariffs to kind of level the playing field in terms of what wealthy countries pay for drugs. Britain, the UK is going to pay a little more. The US, presumably because of lower tariffs, would pay a little less. It's limited, so there's still ways to go, but there is movement in that direction. I think there's also an overall step back thought here which is that this is the Trump administration stepping back from tariffs even more so. Henrietta Trays, who works at Veda Partners, who's always smart on these topics, her take is that this is kind of a sense that both semiconductor and pharma tariffs are less likely in the months ahead. These are the two big areas that have been promised for months and months from the Trump administration. We haven't seen a lot of details, and the details we're getting are things like this with the UK, which is exemptions and which is no tariffs. So her sense is that these new tariffs that Trump has been promising since this summer aren't coming along as quickly. And in her words, they're stalled. So that could be a kind of a win for people that are less fan of these tariffs on these specific industries as well.
Yeah, some fascinating stuff keeping you very busy over the next few weeks, Ben. Thank you so much. Time now for What to Watch Tuesday, December 2nd. Starting off on the earnings front, more retail earnings coming out on Tuesday, along with some names in the tech space. CrowdStrike announcing results for the third quarter after the market close. Analysts expecting CrowdStrike to grow its subscription revenue in Q3 as it launches more products, especially in areas like identity security and AI-powered protection. But the company may feel pressure because existing customers aren't adding seats as quickly, which could weigh on retention rates. Shifting gears to autos, U.S. auto sales data is coming out on Tuesday. Economists forecasting that number to come in at 15.43 million for November. It's a small but positive uptick in demand for new vehicles compared to the prior month, suggesting consumers are still buying cars at a steady pace. And finally, taking a look at the Federal Reserve. Fed official Michelle Bowman is testifying before the U.S. House Financial Services Committee. This coming after a speech from Fed Chair Jerome Powell on Monday. Wall Street will listen closely to all the new commentary for any clues about monetary policy ahead of the Fed's crucial December FOMC meeting. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of this break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.